Hello and welcome to Fitch's virtual investor meeting on European RMBS. Fitch has one-on-one meetings with hundreds of investors each year and want to give you a glimpse inside these meetings. My name is Susanne Matern. I'm a European head of structured finance ratings at Fitch. And with me today, I have England and Alessandro Pighi, co-heads of our European RMBS team. Welcome, both of you.
Thank you.
Now let's start with the UK. We have seen quite an increase in issuance activity this year. What are your expectations for the remainder of this year, Grant?
So far this year, we've seen a lot of the traditional lenders return to the securitisation market. That followed the end of new advances under the Bank of England term funding scheme. This is one trend that we expect to continue. In addition, we expect the continuation of newer lenders. The newer lenders will continue to access the securitisation market because it forms a core part of their funding plans. So, putting together the return of traditional lenders plus the new lenders, we think this year is going to offer UK RMBS investors quite some choice. And in fact, it will be interesting to see how the market responds to this increased issuance supply.
On the topic of new lenders, we have discussed that for quite some time already. But what are the aspects you look at particularly when analysing mortgage portfolios from new lenders?
The new lenders, they typically have an originate to securitise business model. So in this case, our first area of concern is incentives. However, with the examples that we have looked at, this is normally the case that the new lender firstly makes a very significant upfront investment in the new lending platform, and secondly, they retain a significant interest in the future performance of the securitisation transaction. So putting these two components together normally shows that incentives are not an issue from a credit risk point of view. Once that's resolved, we'll go on to look at the lending policy and the target customer base of the new lender. New lenders, they normally have rather limited historical data as would be expected. So one area we look at is a detailed review of the underwriting criteria of the new lender. And the theory there is if the new lender has an underwriting criteria and a target customer aligned with the market standard, then their mortgage origination should, in theory, perform in line with the market standard and vice versa. And the last key area that we look at with new lenders is their operational capability. So what we're looking to see is that the new lender has the sufficient internal setup and policies and procedures in order to actually originate and service mortgage in accordance with their stated policies and procedures and underwriting criteria.
Okay, now that we have spoken so much about new lenders, is this actually only a UK phenomenon, or do we see that also on the on the continental European markets?
We see that, yeah, we see that for sure, not only in residential, in other markets as well. In the Netherlands mainly, the lending from non-banks is growing very rapidly, both in the mortgage space, but also in consumer lending. To focus on the residential markets, for example, new mortgage lending now constitutes more than 20% of annual origination from non-banks. In terms of bank lending, though, there is a retrenchment because regulation is getting more and more conservative on this lending. And in terms of credit risk, from a credit risk perspective, I think the same analysis that Grant was alluding to applies in the Netherlands for new lenders in the RMBS space, where we are able to see similar origination practices, similar loans that are granted to individuals, and also we can get comfortable with underwriting practices given the framework and given how the market in the Netherlands is set up.
Are these new lenders in continental Europe offering the same mortgage products or different loan types?
Sticking with the Netherlands is a very standardized market in terms of mortgage offer at the moment, but the new lenders are focusing mainly on the longer term, so long-term fixed interest rates, and more national guaranteed mortgages. Whereas other platforms, other operators in the Netherlands, mainly coming from non-European money, are less interested in the mortgage guarantee, but they still focus on the long-term fixed rate environment and segment of the market. We rated 4 RMBS new lenders in the Netherlands, and all of them didn't have any mortgage guarantee presence in the pool. That suggests maybe that the money behind them is mainly non-European.
Now, Grant, Alessandro just spoke about fixed rate loans. Do we see actually more of those in the UK market?
In UK mortgage originations, what we've seen is a big shift towards 5-year fixed term periods. Traditionally, the market was focused on 2-year periods. We see 2 key drivers of this shift. One is the regulatory requirements. So under the regulatory requirements, if an obligor has a 5-year fixed rate, the affordability testing is based upon that 5-year fixed rate rather than a stress over and above the variable rate. That's number one. And number two, the current interest rate environment with low fixed rate availability and also potential for increasing rates in the future makes 5-year fixed rates very attractive for borrowers at the moment. So this trend, I think, will continue for the time being. What that means for the securitisation is that prepayments are likely to be lower in the first 5 years because traditionally borrowers refinance after year 2 if that's where their interest rate resets, and it causes often a prepayment in the transaction. So if borrowers have instead a 5-year fixed rate period, they're likely to stay in the transaction for 5 years, so prepayments will be lower for the first 5 years. We also see another linked development recently in UK RMBS. So what that is the inclusion of mortgages that have been advanced in conjunction with the government Help to Buy scheme. So the Help to Buy scheme is aimed primarily at first-time buyers, and what it does, it offers an equity loan to be used in conjunction with a mortgage and a 5% deposit. So for example, in London, a borrower can take out a 40% equity loan, use a 5% deposit and take a 55% LTV mortgage. From our analysis, we think it's important when looking at the 55% LTV mortgage to also take into account the 40% equity loan in this example, so that there's a clear picture of the borrower's incentive to pay and also their ability to pay.
So Grant just spoke about access to credit for first-time borrowers in the UK. Do we see any credit concerns, or do we have any credit concerns on continental European first-time buyers?
Yes, from an affordability perspective, main metropolitan cities in Europe, Amsterdam, Rotterdam, big cities in France and Germany share the same trends. So young borrowers, first-time buyers cannot afford a mortgage. Prices are too high. Similar initiatives to the Help to Buy scheme are present in France, in Germany, in Italy as well, where effectively youngsters are given for favourable conditions, maybe for the short or medium term, to access credit. There are differences though between North of Europe and South of Europe. In North of Europe, the situation I described is quite spread, so affordability remains a constraint for most borrowers. In South of Europe, there are provincial cities where, given where interest rates are, and given the fact that house prices have not increased so much as they did in other parts of the continent, and therefore with the current interest rate environment, youngsters can probably still access credit, provided that employment opportunities still exist. If interest rates were to rise, probably these borrowers would be constrained as the others in Europe.
So definitely an area to watch, first-time borrowers. Yes. Okay. Now, are there any other areas to watch?
So in UK RMBS, we continue to monitor legacy interest-only loans. These are loans that were originated prior to the financial crisis, and at the time, there was not great attention paid to how the principal would be repaid at maturity. Most of these are due to mature around 2030. However, from earlier cohorts, what we are seeing is a high propensity to extend a loan upon the maturity date. So what this may mean for the securitisation transactions in the future, when these loans mature, instead of receiving a timely payment of principal or going into the foreclosure process, we may instead see servicers having to extend the loans. This may put some pressure on the legal final maturity dates for the securitisation transactions if there's a short tail period between the scheduled date of the interest-only loan maturity and the legal final maturity date of the bonds.
Thank you, Grant and Alessandro, for sharing your thoughts with us. And thank you all for joining us. For more on our series of virtual investor meetings, please go to our website, fitchratings.com/virtual. Here you find discussions with other European asset class heads as well as our colleagues in North America and Asia. And if you have any questions, please send us an email to the address on your screen. Thank you very much.